Welcome to today's event where we have the pleasure to present OrderYOYO. To help us through today's presentation, we are joined from the company by CEO Jesper Johansen and CFO Jesper Hyveled. Today's event will cover your Q2 trading update. You sent out the 18th of July, and I think we just said that the full half year's financial statement will come the 22nd of August. As always, it's possible to ask questions in the box down below. We have already had some before the event here, but do feel free to ask during the presentation or in the end of it. But we will take most of the questions there. Do ask in Danish. I will try also to translate to the best of my abilities. But for now, I think I will hand the call over to you, Jesper.
Yes, thank you, Michael. I'm Jesper Johansen, the CEO of the company. I'm here together with Jesper Hyveled. He's with us from Italy, a well-deserved vacation. So that means that I will go through the full presentation, also the financial slides in this presentation. As Michael said, this is a presentation based on the announcement that we came with on the 18th of July. On the 22nd of August, we'll be publishing our half-year results and half-year report, which will be more detailed. And the presentation after that will also be more detailed. So this is more of an overview walkthrough with the ability to ask questions. And then after the 22nd of August, we will come with another presentation, which will be a little more detailed. That was the intro. So Michael, next slide, please. And as always, just 30 seconds of this important information. Thank you, Michael. Next place, please. So just before we delve into the numbers, just a reminder of what OrderYOYO is all about. We liberate your local independent takeaway restaurants, basically ensuring that the local independent takeaway restaurant can claim back their own customers by providing them with a software tool that enables them to transact directly with their own customers instead of with through the portals. And why this is important? For two reasons. Number one, up to 90% of all orders are recurring customers, so the restaurants should take care of these themselves. And number two, from a cost point of view, a cost through a portal would be between 15 and 35% of the order value, and through our system, between 5 and 10%, while also securing that the restaurant maintain their customers. So there's a lot of business case and reasoning for doing this, and this is also why we can see that our market growth is higher than the portals. Now, we are the biggest in the white label space in Europe. We've been that for some time, and we are that through a very targeted strategy, focusing very, very hard on the specific markets we're in. We want to be number one in all the markets we're in. We are number one in the largest markets, UK and Germany, and number one in Ireland, Austria, Northern Ireland, and Denmark. ARR of 302 million, so passing the 300 million mark for the first time, growing 23% year over year, and with a highly increased profitability that we'll go into a little later, but strong numbers. So let's dig into them a little bit. Michael, next slide, please. So June ARR, as I just told you, 23% growth to 302 million end of Q2. So June annualized, comparing this to 246 million in Q2 23, 23% growth. Next slide, please. This actually translates into a higher growth in net revenue. So the first half year of 24, we had net revenues of 148 million, comparing to 116 million in 23. So a 28% growth in a market that is more or less flat. So we're proud about this. Next slide, please, Michael. GMV. So the underlying growth, the underlying orders of the business is increasing as well, reaching the 3 billion mark, 2.9 billion compared to 2.3 billion in Q2 23, so 26% growth. And next slide, Michael. And this is happening with a fundamentally increasing profitability. So profits for second half EBITDA was almost 23 million, up from 9 million in first half of 23. And if we look at the cash EBITDA, next slide, Michael, we are now highly cash positive with a 10 million cash EBITDA compared to minus 5 million in the first half of 23. So 15 million in increase in this over this period. Next slide, Michael. So our outlook for 24, these strong numbers has meant that we have increased our guidance a little bit on some of our key performance indicators. If you take the next slide, Michael. So ARR is kept unchanged for December, so 325 to 325, 325 to 335. GMV the same, also unchanged, 3.3 billion to 3.4 billion. But net revenue is increased from 280 to 290 million to now 290 to 300 million. And our EBITDA is increased from 43 to 48 to 45 to 50 million Danish kroner. Cash EBITDA corresponding increase from 15 to 20 to 17 to 22. So raised 24 guidance that we announced in the announcement on the 18th of July. Next slide, Michael. Just taking a little helicopter perspective on our business. So we have over the last 6 years actually increased our ARR by 10 times. So started out in 2018 with 30 million in ARR and are now at 302. So we have been growing this company quite intensely, and that is also why we are number one in the white label space. In just 6 years, we have 10x our ARR, an accomplishment that we have done while also increasing profitability, as you can see on the next slide, Michael. So being loss-making in 22 and before, we are now consistently on a quarterly basis profitable on the EBITDA and now also on the cash EBITDA level, and has been growing steadily in the last quarters, and are now having a quarterly revenue, so quarterly EBITDA in Q2 of 11.2 million, comparing to 6.3 million in Q2 of 23, so in almost 80% growth. So this growth that we see in the top line is actually also transforming into growth on the profitability line. This is the part of a strategy that we've made from day one, and we're now delivering that at a little faster pace on the profitability path than originally anticipated, which we of course is very happy about. So next slide, Michael. And we see this if we look at the EBITDA and the EBITDA guidance. So 12 months ago, we introduced a long-term EBITDA margin goal of 25% and above that. At that point in time, we were having EBITDA margins of around 10%, and our original guidance for 24 was in the 9 to 11% space, and we just raised this guidance to 16 to 17%. So profitability is here to stay, and we are increasing and delivering on that on an ongoing basis, and we're happy about that. That was a very quick run through, Michael. I would like to hand it over to you, and let's start the Q&A sessions and have discussions around that.
Perfect. The first question is any differences in product sales and momentum, as only revenue guidance is upgraded and not the ARR guidance?
So please say that again.
Is there any difference in products sales momentum, as only revenue guidance is upgraded and not the ARR guidance? You upgraded your GMV, you upgraded your revenue, but you didn't upgrade your ARR guidance. Any thoughts about why that, with the GMV especially being upgraded, why not the ARR guidance?
But the GMV is not upgraded.
Okay, sorry.
Changed, and I think that's basically explaining it. So what's happening now is that a bigger part of the ARR is actually transforming into also net revenue, number one. Number two, sign-up fees that we are having. So basically, when people are buying our product, they need to pay an upfront fee. It's not included in the ARR, and that is included in the net revenue, and that has a little bigger effect on the net revenue part, and that's actually why.
That's why. Perfect. Then the next question: are you increasing investment cost, and how is your gross margin developing?
Okay, So investment cost, I assume that goes on the R&D side of the business.
Yeah.
And if that is the case, we are investing heavily in R&D, more or less at the same level as we did in 23. We have the investment level that I think is needed for this company. So we are more or less in line, maybe a little higher than what we was in 23. In terms of gross margin, we are more or less stable around the same levels as we were in 23.
So because I saw you upgrade your I think your revenue guidance around 10 million and only the EBITDA 2 million in the ranges there. So how should we understand that if you have a higher gross margin? Is there anything special in that?
No, I think that there are other costs involved in this, and these are ranges. So it depends on where you're looking at it. So I think this is basically just a matter of coincidence and anything else. Yes, but anything to add on this gross margins discussion?
I think it's important to understand that part of the uplift in the net revenue, as Jesper said, is the one-time fee, sign-up fees, but it's also POS hardware sales where the gross margin is way lower, and we do see a positive trend on our POS sales, and then additionally, I think the difference here is, as Jesper said as well, the other cost. So our commercial cost, mainly salaries for commercial people. We are heavily investing in that at the moment because we believe in that momentum that we right now see in the markets, and our sales force is performing well, and we have an opportunity to build on that, and that's what is reflecting the cost side of this.
Perfect. Yeah, and of course the margin is increasing, so it was just to understand why it was not why you didn't why more of the revenue didn't get down there in the guidance. Let's see the final results. Yeah, but then maybe a little bit about your competition and the market conditions right now. I think you indicated that it was flat market growth. So something about the market conditions you are seeing in the coming time, and a little bit about the competitive side.
Yeah. Okay. So I think the market is it has been negative. Now it's probably flat, and to be honest, probably a little positive also. So there is which is a good thing for us as well. So we also do see that the portals do have growth in some of these markets. There are growth pockets now. Just taking as an example here. So if you look at a country like France, we are not involved in France in any way. Southern Europe is very difficult for us. We don't want to go in there before we have conquered Northern Europe and Eastern Europe and Western Europe. But actually, Just Eat just said that they're going out of France. So there are different pockets here. But the markets that we're in are seeing flat to plus 5 to 8% growth, I would say, on a yearly basis from an end user point of view, which is strong. Now we're taking market share still, and we're taking that both from the portals but also from other white label space providers. Now, if I should comment a little bit on the white label segment of this, I mean, as I've said before, and that we've talked about before, this is very much a very fragmented market with a lot of local heroes that we are still seeing and that we are still looking into. Obviously, one other big company, which is Flipdish out of Ireland, having a somewhat different strategy than us, and that's basically the competition as we see it. So there hasn't been any changes in that sense. We haven't seen any big moves from some of the larger players into the space.
Perfect. And then maybe to go a little bit away from the business, but there's a question here about your warrant program, and your use of that, and in general, can you talk a little bit about how you use your warrant programs and how it's set up, and how maybe you are making it align with investors' interest?
Yes. So First of all, warrants for us is something to make sure that we can retain the key employees that we have in the business. That's very, very important for us. This is a people business, and we use warrants active to do that. That also means that the programs that we have are long vesting, so it's 4 years programs, and it's made in a way that if people resign, they basically lose all their warrants. This means that the retention part of the warrant is very, very big and very, very important. It also means that once these programs lapses, and we have seen a couple of those lapses, it's based on the company as it was 4 years ago, and this also goes with the strike price. So in that sense, our program is probably different than if you take a company like Novo or some of the bigger companies, where they are more yearly and where they are very, very linked to the current share price. That is, ours are the same, but they are used and are based on a longer term perspective, and that's why you sometimes see that the warrants that are exercised are at a lower price than the current stock price. This is a good thing because it means that we have been able to retain the key employees for 4 years plus, and they are having the benefits of those 4 years through this. I think that's quite important to understand, that it's not a yearly thing. It's actually something that's been given and implemented over a 4-year period. And the current program that we have, which is based on a price of 5.25, lapses by the end of 26. So still almost 2 years left before anything happens there. And that actually means that we retain our key employees for a long time, which is very positive for the company.
Perfect. And then there's a remark that you should give more market data information to the market. I guess you are trying, but is it hard to determine the market because you're only part of the market and large competitors that are not comparable? So can you talk a little bit about why you give some indication of the market growth, but maybe not so in depth? Is it very hard to kind of access exactly what is the market, what is the market growth, and it differs from regions where you maybe not are that the reason, or
I think,
or could you share some more information about market data?
I think it's so from the end user point of view, I think that the best proxy is probably to look at the portals that we are doing as well, to kind of understand what are the trends in the market, and we're giving that. Obviously, this is information from other companies, so it's not for us to kind of put it into our presentations because it's not our information as such, but it is a quite good proxy, and this is actually what we're using when we're talking about the market conditions from an endpoint point of view. Obviously, from white label space, I mean, we do have market intelligence, but again, I can't sit here and give data away that are not publicly available from our competitors. I think that would not be fair. Flipdish, as the biggest competitor that we have out there, is actually, it's not a public company, but they do have annual accounts that are official, and they just gave their results for the 12 months period ending in January 23. So basically almost 12 months old data, but looking at that, it's a company with a revenue of half our size, so 18 million euros, and they are losing on EBITDA 27 million euros. So more than 200 million they're losing on EBITDA compared to us plus 50, and they're growing less than us. These are basically kind of the only public information that I can give. I don't think it's fair for me to elaborate and give market data from other players that are not public.
I understand. It's always very hard when it's such a fragmented market to really have a full overview. Then let's talk a little bit about this positive cash EBITDA. There's a question here. Are the companies self-sustaining now? Of course, looking away from potential M&A transaction, but does that mean this cash positive EBITDA that you are having here, that you are now fully self-sustaining your business?
Yes, we're self-sustaining. That's the short answer. On top of that, we have secured a funding a debt funding facility that we can use in the future in the M&A space. So we're fully self-sustaining.
Perfect. And then there's a little bit of question on which companies you took over in 22 and 23 and what they have contributed with. I think that's a little bit too technical to go into organic rates and so on here, but just to understand for everybody, the growth rates we are seeing right now, that's purely organic, right?
That's like for like.
That's like for like, yeah, because the M&A hasn't been done for it is more than a year ago. So the numbers we are seeing now, that's like for like, and organic, you can always discuss that term, but there's no M&A.
There's a little bit on Kostuku, the one that we did in Q4. That's the only thing.
That's the only thing, but that's kind of marginal, isn't it? The size, yeah. And then there's a question. Maybe we are jumping a little bit ahead of your full year or your half year report, where we will see more on the balance side and the cash flow. But concerning the positive cash EBITDA, do you expect to pay any debt down, or is it allocated to new acquisitions?
Well, I just actually touched a little bit on it. So we are actually bringing in a new debt facility that we can draw on in terms of M&A opportunities if needed. And then the current debt facilities, we do actually see that we will start paying down some of that debt. But it's very important for us that we have enough funding power to do attractive M&A opportunities, both using our own current stock and also cash, and we have that opportunity now.
Perfect. And I know you can't say anything specific, but on the M&A side, are you still seeing the same kind of struggling competitors out there, people interested in consolidating this business? Is that still the same message as you have come with a couple of quarters now?
Yeah, it is. It's exactly the same thing. And the thing is that the ones that we want to acquire are we have a very outbound strategy in terms of M&A. Is the ones that we contact, and that's a longer process than the ones that are in the market. The problem with small companies that go in the market themselves it's almost too late when they do it, right? Because they've kind of tried too hard for too long before they kind of say, okay, let's try to sell it. So we rather want to have an active approach and contact the interesting companies ourselves, and that does mean that it takes a little longer time to close deals.
Perfect. I think that was the questions. Of course, we will get back when we have the half year report and maybe a little bit more details on the cash flow and on the balance side also. But this was at least a good overview on how the business is doing. So thank you to you, Jesper and Jesper, for joining in, and thank you for the audience for listening in and asking questions.
Thank you all.
Thank you very much.